All right, so today we're going to dig into this really fascinating research paper from 2013 that, honestly, it proposes a completely different way to think about one of the most fundamental questions in all of finance. And the big idea? Forget trying to forecast the future. This method looks at what companies are doing right now. So, how much is a company really worth? I mean, this is the multi-trillion-dollar question, right? For decades, you've had investors, analysts, CEOs, everyone wrestling with how to pin an accurate number on a company's value. It's a notoriously difficult puzzle to solve. So, to really get why this new approach is so cool, we first have to look at how this puzzle is traditionally solved. And, why it's so darn challenging.
Okay, so at its core, valuation pretty much breaks down into two big schools of thought. You've got the traditional method, which is all demand side. That's about what we, the investors, demand in future returns. But this new approach we're talking about, it just flips that on its head. It's supply side. It's all about what the managers are actually doing to supply capital, to supply new assets.
And pretty much every standard valuation model you've ever come across, I'm talking dividend discount models, residual income models, the whole shebang, it's all built on this demand side framework. It's really the bedrock of finance textbooks and all of Wall Street's analysis. But here's the big problem. To make any of this work, you need two really key inputs. First, you have to somehow forecast a company's future cash flows, often, many years out into the future. And then you have to pick something called a discount rate to figure out what all that future money is worth today. And let me tell you, both of these are just incredibly difficult to get right. And hey, don't just take my word for it. A leading valuation textbook puts it so bluntly it's almost shocking. The author just says, let's be honest with ourselves. No one knows what the market risk premium is. Think about that for a second. If a critical piece of your entire formula is something that, and I quote, no one knows, well, your final answer is built on some seriously shaky ground. Okay, so this is where our researchers, Federico Bello, Chen Zhai, and Lu Zhang come into the picture. They basically asked a simple question. What if we stop trying to guess the future with our crystal balls, and instead we just look at the concrete actions that managers are taking, right here in the present? Their whole approach is built on this classic economic idea called the Q theory of investment. Now, it sounds kind of complex, but the logic is actually super simple. Rational managers, they're not going to spend $1 to build a new factory unless they believe that factory is worth at least $1 to the company. So their investment decisions literally reveal their beliefs about value. So the logic just flows like this. It's a simple three-step process. When managers, who have the ultimate inside scoop, right, when they see great opportunities, what do? They invest heavily. So, step 2, as outside observers, we see that high level of investment. And from there, step 3, we can kind of reverse engineer their thinking. We can infer that they must see a high value for their company's assets. Their actions speak so much louder than any forecast. And the contrast here is just, it's stark. The demand side needs two super speculative forecasts about the future. But the supply approach, it needs just one single input, the company's current investment relative to its existing capital. That's a real, observable number you can pull right from their financial statements. No crystal ball required. Okay, so this all sounds really elegant and simple, right? But here's the absolute most important part of any new financial theory. Does it actually work when you test it against real-world data? I mean, really, can a model that's based on just one observable input truly explain something as complicated as a company's market valuation? Well, let's see what the researchers actually found. And they didn't just test this on some small, cherry-picked sample. No way. The authors took their model and ran it against a massive data set. We're talking almost half a century of market history, from 1963 all the way to 2011, for basically all public companies in the US. And the results were, well, they were just stunning. So the researchers looked at what's called the valuation spread, which is basically the gap between the most expensive companies and the least expensive ones in the market. Across those 48 years of data, that real-world spread was 4.50. Their simple one-input model, it predicted a spread of 4.45. I mean, that is almost unbelievably close. Yeah, to put a hard number on it, the error was just 1.1% of the observed spread. What does that mean? It means that their model was able to explain over 99% of the valuation difference between high and low-valued firms just by looking at how much they were investing. That's incredible. The paper even has this chart that plots the model's predicted values against the actual values they saw in the market.
And the data points, they fall almost perfectly along the 45-degree line, which, represents a perfect one-to-one forecast. It's honestly the kind of result you just dream of seeing in financial modeling.
But here's the thing, the type of formula they used was absolutely key. When the authors tested a simpler, more straightforward model, it failed badly. I mean, it produced huge errors. Their crucial insight was using a non-linear relationship, one where a small increase in investment could signal a much, much larger increase in value. And that little detail, that's what made all the difference. So what does all this mean in practice, right? This supply-side approach isn't just some academic curiosity. It offers a seriously powerful new tool for anyone trying to figure out a company's true worth. Think about it. Because it doesn't need stock price data, it's super useful for valuing private companies, or even individual plants or IPOs where things like discount rates are basically impossible to estimate. It can also act as a powerful cross-check for those traditional models in, say, mergers and acquisitions. And it gives you a way to gauge whether managers, through their own actions, believe their stock is fairly priced. Pretty cool.
This all suggests that maybe the best way to understand a company's value isn't to build these super complex spreadsheets trying to forecast the distant future. Maybe it's just about paying close attention to the dollars and cents they're actually investing today. And that leaves you with this final thought. If actions really do speak louder than forecasts, what is the market really telling us?